What is up, everyone? Welcome back to another presentation with the Bear Report. Today, we're going to talk about a company that has a lot of traction in the cannabis space, and that's Planet 13. There have been some recent events with this business that have had a material impact on the company's financial statements, along with other things internally, that really paints a grim picture for the future of Planet. But before we jump into this, do us a favor and subscribe to our channel to stay up to date on all our future content. And don't forget to like the video if you enjoy this presentation. The first thing we're going to analyze is management. Here we will look at insider activity, the complex El Capitan Advisors situation, poorly timed decisions, and transparency issues. And next, we're going to get into the core business. This is where we will get a brief overview of their financial statements, the after effects of the El Capitan debacle, liquidity concerns, cannabis rescheduling, and our ultimate bear thesis on this business. And like always, before we dig into all the concerns we have found, it's essential to have a better understanding of what this business does so we can have a full grasp on the bear thesis. So, Planet 13 was founded in 2015 and made their IPO on the Canadian Stock Exchange in OTC markets in 2018. Sorry. It's important to realize that Planet is not currently trading on a major stock exchange like the NYSE because it's not currently federally legal cannabis. And there's lots of restrictions and requirements that they need to meet. The company now has presence in 4 total states with 8 stores operational or almost operational as of February, and over 5 production and cultivation facilities. And their brand name products are sold as wholesale to over hundreds locations around the U.S. So here is an idea of how many stores are operational or about to be operational as of current. We went ahead and updated the slides so we can have a good visual on what stores are where. In Nevada, they have their one superstore and dispensary, accounting for 2 operational stores. This also comes with a distribution license and a couple production facilities. In California, where they have struggled the most, they have their Orange County superstore and a couple additional production facilities and distribution licenses acquired through the Greenwave acquisition. As of current in Florida, they have 4 fully operational or almost operational dispensaries, but we should get more color by management in the next call on this. They also are in the process of acquiring VitaCan, which will add over nearly 26 stores to their portfolio if it closes successfully. Florida had 1 production facility in Central Florida, and they did have a MMTC license, but they are actually selling that and part of that VitaCan acquisition. And lastly, they have their 1 dispensary in Illinois, which just opened up actually. So the company's brand is built around this superstore concept slash like business model. A couple of our team members, including myself, have actually been here, and it really is impressive. It's a great experience, and none of us are cannabis users. So, and Planet 13 builds these superstores, which range roughly from 40,000 to 60,000 square feet. Orange County being the biggest so far at just over 55,000 square feet. And these buildings are massive. And upon entering one of these stores, you are kindly greeted by what they call, or as they call them, bud tenders. And inside each superstore are quality restaurants, lounges, and immersive museums. The the experience is quite incredible. Their goal and model to scaling these superstores, which there are only 2 currently fully operational, is to open a superstore in any city that supports or can support a major professional sports franchise. So, for example, like your NBA or NFL dominant cities. And the issue with this concept, though, is it hinders them with the legislation and regulatory hurdles, state by state and federally. Then Planet also has these dispensaries, or as they call them, the neighborhood stores. These have the same experience as your superstores, but just on a much smaller scale. These range around 4,000 square feet, and their goal is to have more of these neighborhood stores than superstores because they believe it will generate a higher percentage of sales for their in house brands. Now, these are some of the in-house brands Planet 13 manufactures and sells at wholesale and retail stores. I haven't, nor has any of my team members tried their products, but they are in fact the highest quality cannabis products you can buy on the market, and that's true. That's a fact. These brands are like Haha, Trendy, Dreamland, chocolates, and many more here. They sell the flower itself, those gummies, the chocolates, the concentrate, and even vapes. too. So these products are the real deal. I kind of highlighted on this with the superstore concept, but their growth strategy is to expand into markets with their superstore that can support major professional sporting franchises. Once their superstore has landed and gained traction in those markets, they expand with those neighborhood stores. Unfortunately, especially with Florida and Illinois and everywhere really, legislation and regulatory obstacles federally and state by state have really hindered them to execute this growth model to their liking, which, I mean, it's essentially part of the bear thesis on this business. I really wanted to highlight this as well. Planet 13 is currently still led by both of its co founders, Robert Grossbeck and Larry Scheffler. I actually really respect both of these guys greatly, especially with their successful backgrounds, and they still actually have a large stake in the business too. And their entire goal with this brand is to not only change the stigma attached to cannabis, but aim for that experience you get at their retail level, along with its amenities and high quality cannabis based products. Planet wants to be, as some like to say, I've heard it a bunch of times, is the Starbucks of cannabis. Now we're going to get into management, where we will look at everything that falls under leadership, which includes decision making, their transparency, and the El Capitan situation. To tee this off, I want to show a visual of Planet 13's stock price history that correlates with the timeline of events that have happened. As seen here on the left, we have Planet's IPO around 2018. In November of that year, the company opened up their first superstore in Las Vegas, Nevada. This was a great success for a couple years, and it went unnoticed. It really did. In 2020, the pandemic really hit everyone hard, obviously, and you could see how the stock price took a slight decline. But what many didn't realize is Planet 13 adapted and focused on wholesale delivery. This actually had an impressive boost to their sales. As we come out of the pandemic here, Planet started to get liquid and noticed among investors, reaching all time highs around $8 per share. Then we had the worst year ever for cannabis, and poor performance didn't necessarily help Planet's cause either. They started to plateau and decline revenues, and California started to paint a grim picture for the company too. The stock price headed to all time lows. Then a surprise acquisition announcement was released. The company decided to acquire VitaCan, and the market loved this. As you can see, it had a nice spiffy pop. And shortly after this, unfortunate news hit the market that Planet 13 was scammed out of $21.5 million from El Capitan Advisors. The market didn't like this either. However, it was already near all time lows due to poor performance, but this let it back down. We will talk about that scandal in the next couple slides, but from this unfortunate announcement, it really changes the bull thesis for this company since they are now in a difficult liquidity situation. They really are. But the stock is pretty volatile. Today, it trades around between 60 and 80 cents a share. Now, we always look at insider activity, but we will never focus on this unless we find something pretty bizarre. But I do want to talk about the insider buying and selling since IPO and up until today. What you see here are direct selling transactions on the open market. This chart includes buying as well, but there are none from the entire management team and board. Surprisingly, there have been no direct buys ever. But after further investigation, it's really not that big of a concern. I mean, both co-founders have been exercising their options, not selling them after they vest, and they now hold, I mean, significant stakes in the company, which I'll show here in a sec. I do want to point out here on the right-hand side, though, that a select few management team members and board members sold significantly near all-time lows. My thought to this is, why would you be selling and having the most selling transactions in the history of the company and not buying? I find this quite odd, especially when it aligns within the timeline of the El Capitan scandal. If you truly believe in the company's future, I mean, this presents a great opportunity to buy, not sell, and we don't see that here. However, I still don't want to take much weight to this. Both co-founders have large stakes still, and that's really all that matters. Also, here is the insider momentum for the last 12 months. There have been around 8 selling transactions and 0 transactions to buy. And lastly, I have the percentage of ownership among management. Both Larry and Bob have 17% stakes as of their last transactions. So this is actually a really good sign for bulls, and that's why I don't want to look too heavily into this, but I wanted to show it. One of the major building blocks to the bear thesis is due to the recent fraud that has taken place with El Capitan Advisors. I'll get into what has happened specifically in the next couple slides, where we'll look at each lawsuit, but I wanted to give a brief overview quickly. So companies use certain financial institutions to hold their company's cash, kind of like why we bank with certain financial institutions for our personal cash management, but applied here commercially. Since cannabis isn't federally legal, there are a very select few of firms that are allowed to work with Planet. So at the time, El Capitan was one of those select firms that was gaining traction, landing some big cannabis clients, and management decided to choose El Capitan Advisors for cash management services. Unfortunately, fraud eventually entered the picture. This led to them, Planet, losing $21.5 million of cash. As of right now, the company has recovered 3.4 million with 2 million in progress. So total of 5.4 million they're going to get back. But the other 16 million is essentially gone. Now, in order for Planet to recover the remaining amount, they have they have had to sue Casa Verde, who is also an investor and did business with El Capitan. They were scammed essentially like Planet 13 was on a smaller scale. Apparently, Casa Verde received a judgment of 35 million in part of a separate ongoing dispute, which eventually exposed El Capitan as a fraud. And Planet 13, they desperately believe that the 16 million of that 35 million is theirs, which has led them, Planet, to suing Casa Verde in hopes to recover their remaining cash, which is the 16 million, because they're getting 5.4 million back. With what has now happened, and we will show the impact of this in the financial statements, it puts Planet 13, I mean, in financial distress, and we'll show that later on. So let's talk about how this all started, which is kind of complex. So just like bear with me here. Casa Verde, it's an investment firm co-founded by the rapper Snoop Dogg, initially engaged in a partnership with El Capitan Advisors by investing in the firm and utilizing its financial advisory services. Unfortunately, this relationship took a turn when Casa Verde and El Capitan entered into an agreement where El Capitan was going to repurchase shares worth 35 million from Casa Verde. Then El Capitan lied and didn't do this, and they failed to meet this financial obligation, which led to Casa Verde suing them for breach of contract and secured a 35.7 million default judgment against El Capitan. This initiated a series of events that, I mean, would affect all of El Capitan's clients, um, including Planet 13, obviously. So once fraud was admitted by the founder of El Capitan Advisors, it opened the eyes of many of their clients, obviously. And in this case, the one we care about is Planet 13. The issue here is El Capitan didn't have any cash, it was handled fraudulently. And what was left from their scheme was won over to Casa Verde, with the exception of the $5.4 million judgment Planet was able to get from them. But the other 16 million is technically gone right now. So this has led Planet 13 to a desperate attempt to recover 16 million dollars of funds by suing both El Capitan and Casa Verde in another lawsuit. Planet is actually going after both of them with everything they got. So that's a good sign. So they're fighting this. And Casa Verde was actually they were actually caught off guard by the suit, saying they were disappointed by Planet 13 for suing them. But I don't blame Planet for doing this though. They have to do what they got to do to recover the remaining funds. But ultimately, this is how the events have happened over the past 10 months and are still ongoing. This entire debacle really it just throws a wrench in Planet 13's future, which we will show visually later. Another thing I found while I was digging through their SEC filings, since they are on the OTC market as well, so they have to comply, I noticed three letters the SEC sent to Planet 13. Many subscribers that have followed our videos know the context of what SEC letters sent directly to companies mean. 90% of the time, when more than one letter is sent to a company, it's not a good sign. Planet 13 was sent three letters by the SEC, primarily focusing on the need for clarifications and revisions across many sections of their filings: licensing and regulatory compliances, accounting practices, and certain acquisitions. I would cut this management team some slack since they're operating in a highly regulated industry. I mean, they are, it's true. And if they were sent these early on, but these are actually recent letters when I was looking at the dates, recent as of 2022. So that is kind of a concern to me since it basically signals a lack of transparency in the way that you were operating. To top the management component off, we are going to look at the decision making and lack of transparency by management with their California superstore and overall poor performance. What I did here and over the next couple slides is I read the past 3 years earnings call transcripts since California was about to be in operation and is fully operational. What we are looking at here left to right are the Q1 21 to Q3 21 earnings call transcripts. As seen here in Q1, Orange County was about to be operational, and management's expectations were exceptionally high, comparing the pro forma performance to their successful Vegas location at the time. As we move into Q2 21, Orange County is now operational and they're trying to market the location efficiently, effectively, so it can ramp up and get their expected performance, which is understandable from both the bear and bull view. When we head into Q3 here, we start to get into what seems to be a lack of performance and a cycle of the blame game from management. At first, management blames COVID, Omicron, for the lack of activity at their superstore and construction on a major highway. Then they go on to say here at the bottom, they are going to try new and better marketing methods. My initial thought is, why would you choose to open your doors if the construction was going to be an issue? Omicron, we can understand since California was pretty strict on social distancing, but we see this as a management decision making problem. I mean, oddly enough, both co founders have a background with state and local government and real estate. This should have been known going into this. This may seem like nitpicking, but I mean, as we go further in our next slides, you'll see why I'm saying this now and why this whole California situation doesn't make sense. As we transition further into time, Q4 21 here, they re-emphasize the poor performance due to the construction-related obstacles and starts to weigh heavy on the Omicron narrative. Then below that, they are in the process of completing the Green Wave acquisition, which they say will improve their margins in California. Um, we didn't like to see this here for two reasons. One, they're trying to beat around the bush for poor performance and use Green Wave as a relief. And two, this doesn't organically grow the business. It's inorganic growth. And as we move into Q1 2022, management yet again blames Omicron heavily at the top here. Then to finish up California, they reemphasize the construction issues again. I'm like, this really just the construction related issues doesn't make sense to me. This should have been known. It's a foreseeable issue when you're about to open your doors. It should have been known. And they give reassurance that once these construction issues finish, the store will successfully ramp up to their expected performance. Going ahead here to Q2 22, it's now the economy's fault. So we have Omicron, construction issues, and a bad economy to blame for California's poor results. We're trying to give management the benefit of the doubt here, but it's one thing after the other. And when one of these obstacles could have been completely avoided and could have opened this location at a more attractive time instead of burning cash and increasing your operating expenses. To finish this up here, we have the rest of the quarterly transcripts, and we can start to see management accept the poor performance and start to lean on federal cannabis legislation and start some cost cutting improvements. But I want to show how we get there. So when we look at the top here toward Q3 2022, they continue to blame the macro economic environment and they start to lean on hope for federal legalization for cannabis. As you can see, the construction narrative is absent, but remember that was a big hindrance. So, I mean, what happened to that? But below this in Q4 22, we see the improvement from the Green Wave acquisition that we went over last slide, which is inorganic growth. And then they begin to accept the performance from California won't be as successful as they expected from Vegas. As we get into 2023, at the top here in Q1, we see a quarter over quarter decline in revenue from California and highlights how they see improvement from wholesale. I label on the left here because it's true. I mean, wholesale growth is great, but the issue is retail growth and sales. Investors want to see improvement in this segment. So, as we shift further down to Q2 2023, we see yet again another quarter over quarter decline in California revenue and blame the decline on the macro and statewide pricing models. Then, noted in yellow here, hopefully you can see this. Management is starting to focus on improving their operating costs in California. So now they are shifting their entire perspective to lowering costs, and we will get into their financial statements next, so we can see how this really is impacting their cash flows. Lastly, here at the most recent earnings call in Q3 2023, revenue slightly increased in Cali, and cost control initiatives started to be implemented to reduce operating costs in the state. So the whole point of this was to not only point out the poor decision making from in results from California and how they're heavily relying on federal legalization, but to also show the lack of transparency to shareholders. Management hopped from one excuse to the other for nearly 3 years. Then, most recently, shareholders actually start to see the reasons why, and that's ultimately from the decision making by this management team, and not waiting until not to say waiting until legalization, but they could have waited until it was a better time, until it was more clear and concise. So now the company is having to sit on this location and burn through cash from increased operating expenses. So we are now going to dive into the core business, where we will look over their financial statements, the impact from the El Capitan situation, liquidity issues, cannabis legislation, and our bear thesis on this company. Like we always do when we look at the core business, we are going to take a look at the restated 10Q from Q3 2023, specifically their condensed consolidated statements of operations and cash flows. Later, we are also going to compare the before and after of the El Capitan situation. So, what you're looking at here is the statements of operations. We're going to start at the top at revenues and look at both the 3 months and 9 months year over year increases and decreases. Revenue for 3 months ended was down 3%, and down 9 months ended at 5%. Below that, looking at gross profit, it was actually up near 5% in green here, so that's good, but it was actually down almost 10% for 9 months ended. Shifting to marketing, these were up 43% and 65%. And the reason these are up is primarily due to increased marketing spend, like when they said they were going to optimize marketing efficiency in California from the transcripts. And some of this was also increased spend in Illinois and Florida, since they are operational or about to be in operation. Below this, we have the impairment loss, and this is from their Florida MMTC license that's part of that VitaCan deal. The loss is because the value of the license actually decreased, and this was done by a third party, and it had to be done for the acquisition. Unfortunately, Planet has to report this on their financial statements since the deal hasn't closed yet. Then to wrap up total expenses, it increased almost 270% and 81%. And most of this was inflated due to that impairment loss. But keep in mind, though, total expenses was around $15 million. Looking down further at provision for misappropriated funds, I have $2 million highlighted. This is actually the $2 million Planet is still owed and being held by the Orange County Sheriff's Office from that whole El Capitan ordeal. Then going down to net loss at the bottom here, which is the worst metric and issue with this company. They had over a 630% increase in net loss for 3 months ended, and an increase of 240% for 9 months ended. Now, again, the impairment loss inflates this, but even without it, the net loss was still higher, just above 7 million for 3 months and almost 20 million for 9 months. So net loss is actually widening even if we take off the impairment. This is the cash flow statement from Q3 2023 restated. This is where we start to see the cash burn taking place in comparison with their cash reserve. At the top here, we have the 9 months net loss, like we just went over last slide. Then we go to the middle here at total operating, highlighted. which is cash used in operating activities in this cash flow statement, it was up nearly 150% year over year. I have an arrow at the side here. This is basically cash burn for the company, which is not good because it's increasing and it's likely going to continue to fluctuate on the upward trend since Planet is indeed focused on scaling for growth right now. Some bulls will point to the VDCAN acquisition that will bring in more cash flow, but this is kind of a fallacy because we are unable to know what exactly their profit margins are like, and bulls don't understand there are also integration and transition costs with this too, and they're not cheap. Um, it doesn't help when you have a struggling superstore like California, and even in some cases with Nevada fueling that cash burn and not meeting the initial expectations. Going down to purchase a property, plant, and equipment, this was actually a decrease, but it's going to wildly fluctuate depending on how much further the company wants to scale or scales. In return, we have a lower total investing metric, which is neutral, but this should be noted. That brings us to the net change in cash. This was just over 18 million. Now, when I talked about cash used in operating expenses, that's the 11 million number we see in the middle. We don't count investing activities since that's not cash used to fund operations, but it does add to more cash being used, if that makes sense. Finally, at the bottom here, we can see the change in their cash position from the beginning of the period and end of the period. It represents a nearly 48% decrease in cash. And unfortunately, the El Capitan situation made this liquidity issue even more concerning, which we'll get into in a second. Now, what you are looking at is their 10K for an annual visual. I also added 2023's preliminary results, which Planet 13 released late February. As you can see, these metrics are not healthy. For 3 years now, the revenue has been declining. In return, this reflects into gross profit as well. You want to see incremental increases in these metrics as a retailer. And when we look down at net loss, Planet has a widening net loss for operations, hitting 73 million. These metrics are not good. And this is over a span in 3 years. And what most would say now, a resilient economy. So the blame game should be disregarded, but federal legalization for cannabis does hinder them. It really does. But should it be suffocating them like this? That's the question. Should it be this bad? Because 2021's peak numbers were quite strong without it. So that's something to think about. I want to show this because when revenues decline, net loss tends to widen, and that's what's happening here. In return, this increases cash burn. This gets us to what we believe puts the company in a concerning liquidity issue. So, with all that said, let's take a deep look at the company's cash position before the El Capitan situation and after it. Before the scandal, the company was pretty comfortable at 36 million at the cash metric here, which would have likely lasted them until we get favorable legalization on cannabis. As we move over linearly, we hit this 21.6 million number, which represents the total amount, including some fees associated with the fraud that took place. After the fraud, this brought them down to a distressful number of 15 million. Now, this is from the entire 21.6 million, but Planet 13 is going to recover 5.4 million back, with 3.4 million already processed and 2 million in processing, which is why we have this 5.4 number below the 15 million number. If we add both of these numbers, we get our total cash position like we just went over in the last couple slides. This essentially affected their assets as well, bringing that number down. So bulls need to really analyze Planet's current cash flow situation and cash position with this fraud that took place. This puts the company in a very difficult situation, capital wise, and questions them if this is sustainable in the future. Even if legalization happens, though, the company will still be in a tough situation where they will have to raise money by diluting shareholders at some point. If they can somehow get listed on a major exchange and get institutional funding, that could possibly work. But they don't even meet the listing requirements for that perfect scenario. But Good news coming from us at the Bear Report. We would agree, however, that diluting shareholders in a federally legalized cannabis society would actually really be beneficial in comparison, to the untapped potential and value with this company, if it is. We will get into more on the cannabis rescheduling later. Before we get into that rescheduling situation, I want to show these cash flow numbers in a visual straight from their 10Qs, so you don't think we are full of crap on this. As seen, net cash used in operating activities highlighted twice was just over 11 million, the number we emphasized multiple times in the cash flow statement. If they can somehow cut costs to suppress this growing number, I think they can make it past a year. That's possible, and that would give them enough time. I think. But let's see what management said about this and hid in their restated 10Q. And I encourage everybody watching this to go and read this in their 10Q, or if you can read it here, great. But management gives reassurance about securely funding operations for the next 12 months, which I think will be possible. I think that is possible. That's realistic. That's realistic. However, they go on to acknowledge that the long term, whatever that is considered, they will need to seek capital raises. They say they will be able to do this with risks attached to it, which really hints at dilution and is the most common way for companies in financial distress to raise capital. So, do with what you want with this information. I just want to put this here. But it seems to me like management is acknowledging this, that it's an issue. The current legal status of cannabis at the federal level is that it remains classified as a Schedule One substance under the Controlled Substances Act. This classification is considered to be like high potential for abuse. Uh, no currently accepted medical use and treatment in the U.S., and a lack of accepted safety for use under medical supervision. So the United States is not a fan of cannabis right now, but they're working towards rescheduling this to a Schedule 3 drug. So, given the recent back and forth by the Department of Health and Human Services to the DEA, the Drug Enforcement Administration, to reschedule marijuana to a Schedule 3, there's a potential shift in the legal status on the horizon. So I'm going to say horizon. I don't know when it's going to be. It's soon. That's my best guess. But soon could be a year. It could be 2 years. Who knows? We're dealing with the U.S. government. But Schedule 3 classification would acknowledge cannabis's accepted medical use, and it would also acknowledge like lower, instead of high potential for abuse, it'd be lower potential for abuse. So I guess my best way to put this is think about cannabis as being on the same level as alcohol. That should probably give you an idea of what it would be like. Cannabis would be regulated like alcohol. However, like I just said, the timeline for when a final decision might be made, it's just uncertain. Um, we don't know that. As of right now, the DEA has not yet publicly responded to the Human and Health Services recommendation or provided a specific timeline for that decision. But the process, from what I researched and what we've done, is it involves like a thorough review, which includes like scientific evidence, public health impacts, the potential for abuse, like we went over. So this could take significant amount of time if the DEA wants to accept this. On top of this, any decision to reschedule would need to follow the a rulemaking process outlined in what they call the Administrative Procedures Act, which includes public notice and opportunity for comment, whatever that means. Um, but given these, what's going on here, like with the steps that are being taken, and like depending on the complexity of the findings and what's going on, the input, whatever happens between the Human Health Services and DEA, the timeline could extend, like I said, several months to maybe potentially over a year. We don't know. So my question to Bulls is: can we really count on this unpredictable verdict? Because Planet doesn't have they really do not have much time until they are being drained, financially. This gets us to our ultimate bear thesis on this company, and that's that the business is suffering from major liquidity and scaling issues right now. With the many reasons we went over on decision making, unhealthy business growth, the legal obstacles, and management's lack of transparency, it has now put them in this current position, which will be tough for them to navigate in the future. I mean, even in a cannabis legal society, it is possible this company can make a turnaround once federal legalization happens. They will have to dilute shareholders during the process, but it definitely can be done. It really just comes down to timing with Planet 13. And the question is, how much longer do they have until they have to make some restructuring initiatives? But that is it for this presentation. If you enjoyed this content, give us a subscribe so you can stay up to date on our biweekly videos, and make sure you give us a thumbs up. Thanks for watching.